Finance company operation. So what is a finance company? The finance company is an entity that lends money to individuals and businesses. So the primarily function of finance companies is to make loans to individuals. Finance company borrow money from sources such as the Federal Reserve System and commercial banks at a low interest rate and lend it at a higher interest rate. This is the reason the interest rate charged by finance companies are higher than the interest rates charged by banks. Companies and individuals turn to finance companies when they don't qualify for bank loans. The function of finance companies are to offer both unsecured and secured loans to individuals and companies. So example for finance company here in the Philippines are BDO, BPI, and Union Bank. Finance companies offer consumer and small businesses access to short and intermediate term finance. Only finance businesses are expert in this service, while other financial organizations also offer it. Many finance organizations just have one office while others have hundreds of locations across the nation and even abroad. An independent finance firm or a division of a financial conglomerate may carry out consumer finance operations.
Let's go down to the types of finance companies. Finance companies are commonly classified into the different types according to the specific services that they offer. Some finance companies could fit in every category because they offer all types of services. These are the types of finance company: a consumer finance company, business finance company, captive finance subsidiaries, and regulation of finance companies. A consumer finance company provides financing for customers of retail stores or wholesalers, whereas a business finance company offers loans to small businesses, like buying and selling products, issuing stocks, initiating loans, and maintaining accounts. A captive finance subsidiary is a wholly owned subsidiary whose primary purpose is to finance sales of the parent company's products and services, provide wholesale financing to distributors of the parent company's products, and purchase receivable of the parent company. Regulation of finance companies. Finance companies generally have to comply with federal statutes governing equal credit opportunity, proper disclosure, and truth in lending, as well as the Financial Reform Act of 2010 prohibition against deceptive and unfair practices. The Financial Protection Bureau, which was established by Financial Reform Act, is responsible for regulating various consumer finance products and services that may be offered by finance companies and other institutions. The main source of finance company funds are loans from banks, sales of commercial paper, deposits, bonds, and capital. Loan from banks: this is where finance company borrow from commercial banks and can renew the loans over the time. Bank loans can provide a continual source of funds, although some finance company use bank loans mainly to accommodate seasonal swings in their business. Sales of commercial paper. Despite the fact that commercial paper is only accessible for short term, in order to establish a steady stream of funding, finance companies can repeatedly roll over their outstanding concerns. Due to the default risk, unsecured commercial paper provides to investors. Only the most well-known finance company have historically been able to issue commercial paper to raise money. Deposits. Some states allow finance company to attract funds by offering customer deposits. Bonds. For those finance companies that need long term of funds can also be issued in bonds. For instance, when the company's assets are less interest rate sensitive than its liabilities, and when interest rates are expected to increase, Bonds can provide long-term financing at a rate that is completely insulated from rising market rates. If the finance company is confident that interest rates will rise, then it might consider using the funds obtained from bonds to offer loans with variable interest rates. Capital. Finance companies can build their capital base by retaining earnings or by issuing stock. Like other financial institutions, finance companies maintain a low level of capital as a percentage of total assets. Several finance companies have engaged in initial public offerings of stock so that they could expand their business. The main uses of finance company funds are consumer loans, business loans and leasing, and real estate loans. Consumer loans, this is where finance companies extend consumer loans in the form of personal loans. In addition to offering automobile loans, finance companies offer personal loans for home improvement, mobile homes, and a variety of other personal expenses. Also, personal loans are often secured by a co-signer or by real property. For example, a retail store may sell products to customers on credit and then sell the credit contract to a finance company. Furthermore, commercial banks and credit unions are the major rivals of finance business in the consumer lending sector. Credit unions have regularly given consumers more credit than finance firms have, although they are a distant second for business banks. Business loans and leasing. In addition to consumer loans, finance companies also provide business commercial loans. Leasing is the another way that financial companies offer funding. They buy machinery or equipment and then lease it to firms that would rather avoid the additional debt that acquisition would necessitate on their balance sheet. A company that is currently at or near its debt limit and is worried that taking on further debt may harm its credit rating may find it vital to avoid debt. Real estate loans. Finance companies offer real estate loans in the form of mortgages on commercial real estate and second mortgages in a residential real estate. The particular allocation of finance companies' uses of funds depends on whether the company is focused on business or consumer lending. Some finance companies, such as GE Capital, provide all types of services. The illustration of Exhibit 22.1 summarizes the sources and uses of funds by illustrating how finance companies finance economic growth. They channel funds from institutional investors who purchase the securities they issue to households and small businesses that needs funds. In 2010, the Financial Reform Act established the Consumer Financial Protection Bureau, which is responsible for regulating various consumer finance products and services that may be offered by finance companies and other financial institutions. Perhaps the most important requirement on finance companies is that they ensure proper disclosure of information about their financial services. When finance companies obtain or use funds, they interact with other financial institutions, as summarized in the illustration of Exhibit 22.2. Because of their concentration in consumer lending, finance companies compete with commercial banks, savings institutions, and credit unions. However, those finance companies with subsidiaries that specialize in other financial services compete with insurance companies and pension plans. Finance companies utilize various financial markets to manage their operations. As summarized in the illustration of Exhibit 22.3, for their core business, finance companies commonly rely on money markets, which is commercial paper, and bond markets to obtain funds. Furthermore, the insurance subsidiary of finance company often utilize bonds and stock markets to invest funds. This subsidiary may also use futures, options, and swap markets to hedge the risk.
Valuation of a finance company. So, finance companies or consumer finance units that are part of a financial conglomerate are commonly valued by their manager to monitor progress over time. or by other financial institutions that are considering an acquisition. The value of a finance company can be modeled as the present value of its future cash flows. Thus, the value of a finance company should change and respond to changes in its expected cash flows in the future and to changes in the required rate of return by investors. So, factors that affect cash flows. So, we have economic growth, change in risk-free interest rates, change in industry condition, and lastly, change in management abilities. So, economic growth is an increase in production of goods and services in an economy. Increases in capital goods, labor force, technology, and human capital can all contribute to economic growth. It can also enhance a finance company's cash flows by increasing household demand for consumer loans, thereby allowing the finance company to provide more loans. So second, change in the risk-free interest rates. So what is a risk-free rate? The risk-free rate of return is the interest rate an investor can expect to earn on an investment that carries zero risk. Cash flows may be inversely related to interest rate movements, and finance companies rely heavily on short-term funds. Third is the change in industry condition. So condition includes regulatory constraints, technology, and competition within the industry. And lastly, change in management abilities. So managers attempt to make internal decisions that will capitalize on external forces such as economic growth, interest rate, and regulatory constraints. Factors that affect the required rate of return. So the required rate of return by investor who invests in a finance company can be modeled as you can see, it's flash on screen. So whereas RF represent the risk-free interest rate and RP represent the risk premium. The risk-free interest rate is normally expected to be positively related to inflation, so economic growth, and the budget deficit level, but inversely related to money supply growth, assuming that it does not cause inflation. So the risk premium on a finance company is inversely related to economic growth because there is a less uncertainty about loan repayments when economic conditions are strong. The risk premium is also inversely related to the company's management skills, as more skillful manager may be able to focus on financial services that reduce the finance company's exposure to risk. Exhibit 22.4 provides a framework for valuing a finance company based on preceding discussion. In general, the value of a finance company is favorably affected by strong economic growth, a reduction in interest rate, and skilled management. The sensitivity of finance company value to this condition depends on its own characteristics. The higher the risk tolerance reflected in the loans provided by a finance company, the more sensitive its valuation to changes in economic growth and therefore in the ability of borrowers to repay their loans. Exposure of finance companies to risk. So we have liquidity risk, interest rate risk, and credit risk. So liquidity risk is the danger of suffering losses as a result of not being able to make payments on time when they are due. Example of liquidity risk are when a corporation is unable to readily turn its excess asset into cash and its inability to pay its debt due to a lack of current asset. So another instance would be when an asset is insufficiently liquid and needs to be sold at a discount to its market value. So barato pagkabaligya. Finance companies are generally do not hold asset that could be easily sold in the secondary market. However, their balance sheet structure does not call for much liquidity. Virtually all their funds are from borrowing rather than deposits. Consequently, they are not susceptible to unexpected deposit withdrawals. Overall, the liquidity risk of finance companies is less than that of other financial institutions. So second, interest rate risk. Both liability and asset maturities of finance companies are short or intermediate term. Therefore, they are not as susceptible in increasing interest rates as savings institutions are. Finance companies can be adversely affected. However, because of their assets are typically not as rate sensitive as their liabilities, they can shorten their average asset life or make greater use of adjustable rates if they wish to reduce their interest rate risk. And lastly, credit risk. Because the majority of a finance company's funds are allocated as loans to consumers and businesses, credit risk is a major concern. Customers who borrow from finance companies usually exhibit a moderate degree of risk. The loan delinquency rate of a finance companies is typically higher than that of other lending financial institutions. However, this higher default level may be more than offset by their higher average rate charged on loans, because their loans entails both relatively higher returns and higher risk. The performance of finance companies can be quite sensitive to prevailing economic conditions. Multinational finance companies. So some finance companies are large multinational corporations with subsidiaries in several countries. For example, GE Money provides consumer finance service in 55 countries and serve more than 130 million customers around the world. It provides products and services in local currency when it does businesses.